Let's bring him on anyway and see what he's got to say about it all. It's Mr. Craig Bolanos. He's the co-founder and wealth partner in VestGen Wealth Partners in Chicago. Wealth advisor, sorry, with VestGen Wealth Partners. Thanks for being on, brother. Okay. It's you know what? Why don't you tell everybody else what you and I were talking about, and I agree with you about this pattern we've seen since the war started on that weekend.
Oh, it's incredibly fascinating because we've played out now for this. I think this will be the fourth week of the pattern where every Thursday, every Friday, the market just goes down. And the presumption there has to be it's not the timing of news. It's investors, well, specifically traders, I guess, not wanting to be long into the weekend. And then we end up getting these rallies on Monday, partway into Tuesday, and then we go flat from there. But it's kind of getting boring. But that's the pattern now, 4 straight weeks of it. I mean, what are we really paying attention to? I'm paying attention to the fact that that dual mandate from the Fed is going to be much tougher than the market anticipated, especially with the numbers you just mentioned. You just mentioned the 10-year. I see mortgage brokers and residential real estate contracts starting to get a little shaky as we get into the prime spring season just after Easter with higher rates. And in addition to that, I got to look at the break even. I mean, I just saw some tips come across my screen yesterday, and we're looking at 5-year inflation numbers anchored with a break-even rate of 266. That's a 3-year high. What does that tell me? Well, that tells me that, boy, we got to be a little bit worried that we're going to be fighting a dual front of a slowing economy with rising prices. Now, I got more to say, Scott, but that's my opening remarks of what you and I talked about in the green room.
Yeah, right. Well, I tell you, another thing that I did this yesterday on my show is it's a little bit disconcerting is this, right now, these price spikes that we have with oil, right? In the short term, inflationary, there's going to be some stagflationary talk. You just alluded to it there with what you were talking about. But the longer it goes on, it turns into, say, some demand destruction, and you start to worry about the economy, and you go from rate hikes to battle inflation to rate cuts to get the economy going. The same event has 2 different flavors depending on how long it goes on for. But the one thing I want to throw in on top of it, which I did not like, and I saw it yesterday, so I reported on it. But M2, the money supply, just set another record. And that means there's a ton of cash out in the system. You combine that with the fact that we just had a hot PPI of 0.7% month over month, which everybody loves to extrapolate out 8.4% for the year. And then with the oil spikes that we've seen, you can't turn your head on this inflation issue, can you?
No, you can't turn your head on the inflation issue. I just think it needs to be talked about more. That's why I'm looking at the break-even rate on some of these tips. But the reality is that's where I think investors, if we're talking about your game plan, make sure you're investing in those cash cows. I was just reminded about that looking at what it is you're wearing again yet today, because I think companies that are generating tremendous free cash flow are going to be able to substantially and continuously grow their dividend. Again, growing dividend growers, not high yielders. But Scott, let's not forget there is a pathway, although the pathway is starting to feel more narrow. And I'm not talking about my NCAA bracket, which is very narrow. What I'm referring to here is that this war, I'm going to call it a war, it could suddenly pause, get a little better. You could all of a sudden see the price of oil come down. You could see earnings, which we had coming in, which were strong. You could see the labor market resilient. And if that's the case, this is great because we just reset the equity multiples on an awful lot of tech stocks that are a big part of the S&P. And this could be a good setup for 2027. I didn't say a great setup for 2026 because you got the midterm election and all the trading patterns that go around that. But this could be just taking a pause, taking a year off to digest and consolidate before we get back to market returns that go back to normal. And who wouldn't celebrate normal? I would. And I think volatility is the price that investors pay. And hey, I think crypto is 95% of the way done. And I'm encouraged by something. There's all these different oil contracts with WTI, Brent, Dubai, you name it. The spread between WTI and, like, say, Dubai, that blew out. It's starting to narrow. So there must be some belief that better days are ahead.
Yeah, I mean, that's a great one to take a look at. It was real close when we broke out, and now that it widened substantially. And you're right, it is coming back in. Before we go, though, You mentioned something I want you to kind of really quickly explain as best as possible to the listeners what TIPS are, right? These inflation-protected bonds. Why don't you talk to them about that real quick so they have an idea, but when you talk about these break-evens.
Scott, I've learned from you. You've said this for years to me now. The smart money is always the bond money for whatever reason. Home of the institutions, home of the discipline. And Treasury inflation protection securities, TIPS, which we've all learned from Scott. Treasury inflation protection securities are basically a great forecaster of intended or expected inflation. And when we see TIPS yields running at 266, that tells me, and it's proof, that this idea of we're getting down to a 2% rate just isn't happening. We can probably all expect to be in that 266 range. I'm checking my computer screen right now when we do 5-year forecasts. So that's what TIPS do. They're Treasury inflation protection securities.
Yeah, and that's a great forecaster. You're exactly right. And, I just don't like the other things that are going around it, like we talked about in the green room, with what I've seen with the M2 money supply, with what we've gotten with the last hot PPI number, obviously with the petroleum and oil and all those things, the higher price brings with that. It just makes the job harder. That's all. It doesn't mean it can't be done. But I think this cannot be a May problem. This has got to be over with by the end of April, and then I think we have a decent chance. But it cannot be a May problem because that really starts to move from that price spike, one-off kind of a thing where we have to worry about inflation. Then we start to worry about demand destruction and what's actually doing to the economy. And that changes the picture dramatically, I think. And that turns us from a rate hike environment to a rate cut environment. And everybody that wants a rate cut, be careful. You might get them, but not for all the reasons you thought we were going to get them. So great to have you on. Have a great weekend, Craig. Thanks for being on. Always, your content is superior. A lot of people write in and tell us they love what you have to say. Thank you very much for contributing to this show and the Cow Guy Close. Appreciate it. Have a great weekend.